The Fed says they may be able to bring inflation down without hurting the economy, but really tricky proposition.
Fed Chief Jerome Powell telling the Senate Banking Committee today that he is committed to bringing down inflation, but he acknowledged aggressive rate hikes could tilt the economy into a recession.
Jerome Powell expressed confidence that the American economy can handle the central bank's higher interest rates, despite rising fears of a recession. Powell said that the Fed is very careful monitoring the economy and is prepared to act as needed. In this video, I'm going to cover the latest Fed's testimony and how Cathie Wood believes that recession has already started. So stay tuned till the last, as I'm also going to show you some evidence backing Cathie Wood's viewpoint on recession. Before diving into the video, be sure to subscribe to my channel for more updates on the latest market happenings. So let's start with Cathie Wood's view on recession and economy.
A recession is quite possible here in the United States. A recession is defined as 2 consecutive quarters of declines in GDP. We've had one, and I wouldn't be surprised to see another either in the second quarter or the third. So technically, we would, if we were positive in the second and went negative again in the third, that's not a technical recession. But in my book, it's close enough. Real average hourly earnings have been falling since April of 21 on a year-over-year basis. They were down 3.4% in April of 21. They're still down 2.6%, but there's been a consistent decline over the past year. And I think those in the high inflation camp expected wage growth to continue accelerating. That is not happening, and I think that I think that's the linchpin of those who think that inflation is out of control and is only going to get worse.
The Federal Reserve recently raised interest rates to 75 basis points, citing inflation indicators like the CPI as the reason for the hike. Cathie Wood believes that the Fed is more worried about its legacy than the actual economy. She argues that raising rates too quickly could lead to a recession. She also tweeted the yield curve as measured by the difference between 10- and 2-year Treasury yields has flattened, which is a harbinger of a recession.
So the fear of rising interest rates and inflation out of control has gripped the market.
Cathie Wood has warned the Federal Reserve could cause a recession if it keeps hiking interest rates. Do you agree with her? Let me know your thoughts in the comments below. Now, in this semi-annual testimony, Powell explains that the Fed is doing as much as it can to keep prices stable and maintain maximum sustainable employment. Let's listen to what he says. Before that, be sure to like and share my video. Really appreciated.
At the Fed, we understand the hardship that high inflation is causing. We are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. A box in the June Monetary Policy Report discusses developments in employment and earnings across all major demographic groups. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation poses significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. With inflation well above our longer-run goal of 2% and an extremely tight labor market, we raised the target range for the federal funds rate at each of our past 3 meetings, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store.
Powell explains that the Fed is not trying to engineer a recession to stop inflation, but is fully committed to bringing prices under control, even if doing so risks an economic downturn. According to him, further surprises could be in store. He also added that there was a risk the Fed's actions could lead to a rise in unemployment. If you find this video informative, be sure to give a big thumbs up. Let's continue with what's happening currently and what big leaders and companies have to say on recession.
Elon Musk said that he has a super bad feeling about the economy. Jamie Dimon at JP Morgan talked about a hurricane. Be prepared for a hurricane. He doesn't know what kind of hurricane. Is it going to be a mild one, or is it going to be a Hurricane Sandy, which would be quite serious? But I think he's changed his tune a bit in the last month since JP Morgan reported earnings. So what is he saying? Well, he sees a lot of business activity and must see it slowing down, if I had to guess. And the president of Goldman described this environment as a confluence of shocks that in his career has been unprecedented. So again, he has a very good perspective, global perspective, every sector. And so I would say at the margin, these 3 business leaders are seeing the economy in some form of stress.
Cathie Wood is not the only one to predict a recession. Goldman Sachs also issued a report saying that a recession is likely. However, Cathie Wood believes that recession in the U.S. has already begun. Jamie Dimon said earlier this month that the economy could be headed for a hurricane. Well, a big layoff has also started in the mortgage sector. JP Morgan Chase is reportedly laying off hundreds of employees in its home lending unit. Not just this, they're transferring hundreds more to other parts of the bank as climbing mortgage rates pressure demand for purchase mortgages and refinancing. Real estate brokers Compass and Redfin also said last week they would cut jobs as home buying demand was slowing due to rising mortgage rates and surging inflation. Earlier this month, Elon Musk was seen having a super bad feeling about the economy, and according to Reuters, Tesla decided to pause all hiring worldwide. Recently, in an interview at the Qatar Economic Forum in Doha, Elon Musk confirmed that Tesla's salaried workforce will be reduced by about 10% over the next 3 months. PayPal also began cutting staff last month as its push to reduce costs ramps up. Now, we all know the great collapse in stock and crypto prices. Now, due to this collapse, Coinbase is also planning to lay off almost 1/5 of its workforce. That's a lot of laying off going on in every sector. Now, the entertainment sector is not behind it all. Netflix has reported in April that it lost subscribers for the first time in more than a decade. Last month, Netflix laid off 150 workers, placing the blame on slowing revenue growth. Now they have done the second round of laying off, so a total of 2% of its overall workforce has been laid off till now. Recently, Cathie Wood also tweeted that consumer sentiment has dipped to levels not seen since the global financial crisis of 2008 to 2009 and the 2 recessions in 1980 and 82. This is a worrying trend for the economy. If consumers continue to feel pessimistic, it could lead to a slowdown in growth or even a recession. It's clear that the consumers are feeling more anxious about the future, especially with additional rate hikes and recession coming. Time will tell what impact will enter the economy. Do you believe that recession has already entered? Will the Fed keep increasing interest rates? Let me know your thoughts in the comments below. I will see you in my next video. So to get notified for my next video, be sure to hit that bell icon. And don't forget to subscribe to my channel. Adios!